Welcome to the Deep Dive. We turn complex financial stuff into insights you can actually use. Today we're getting into something called adjustments to adjusted gross income. Sounds technical, I know, but think of it like finding ways to keep more of your own money. People often call these above-the-line deductions.
Exactly. And our mission here is really to slice through the complexity, pull out the most important bits about these adjustments. We want you to quickly get what they are, who they help, and honestly, why they matter so much for your finances overall.
And just so you know, everything we're talking about comes straight from a detailed guide on these adjustments. So this isn't just guesswork, it's based on solid info.
Okay, before we jump into the different types, let's just nail down what adjusted gross income AGI really is. Think of AGI as like the starting point for figuring out your taxes. It's your total income after you subtract these specific adjustments we're focusing on today. And AGI is super important because it affects your eligibility for a lot of other things, deductions, credits, all sorts of stuff. So reducing your AGI directly above the line can have this ripple effect, potentially lowering your tax bill quite a bit.
And here's a little tidbit. The CPA exam, the big test for accountants.
Oh, yeah.
It specifically calls these deductions to arrive at adjusted gross income. That really tells you how official and, well, important they are in the tax world. Okay, so let's get the big picture first. What kind of adjustments are we actually talking about here?
The guide lists quite a few. Educator expenses, traditional IRA contributions, student loan interest, health savings accounts, moving expenses. Those are very limited now. Also, the deductible part of self-employment tax, self-employed health insurance, self-employed retirement plans, penalty on early withdrawal of savings, alimony paid with a really key date there, and even some specific attorney fees.
It's quite a list. And the interesting thing is, they all do the same basic job. They lower your taxable income. Simple as that.
Lower income means potentially lower tax. Exactly. And because they're above the line, they cut down your AGI directly, which, like we said, can open doors to other tax benefits later on. It kind of sets the stage.
All right, let's zoom in. Makes sense to start with the first one on that list. Educator expenses. Who gets to take this one?
This one's pretty specific. It's for K through 12 teachers, instructors, counselors, principals, or aides. The main requirement is working in a school for at least 900 hours during the school year. So really for folks in the classroom.
Okay, 900 hours. And what's the deduction limit? How much can they actually deduct?
So the limit is up to $300 for qualified expenses. Now, if you have a married couple filing jointly, and they're both eligible educators, then they can deduct up to $600 total. But, and this is important, neither spouse can claim more than $300 of their own expenses.
Got it. So you can't pool $400 from one person and $200 from the other. It's $300 max per person.
Precisely.
And qualified expenses. What does that cover? Things they buy for the classroom.
Yeah, basically. The key terms are ordinary and necessary. Ordinary just means it's common in their line of work. Necessary means it's helpful and appropriate, not that it was like absolutely required by the school.
Okay.
So this includes books, supplies, equipment that now covers PPE, computers, software, services too, other classroom materials, and also professional development costs.
That's good to know about professional development. What about things that don't count?
Right. You can't deduct expenses for homeschooling. Also, non-athletic supplies for health or PE classes are out. And you have to reduce your deductible expenses by certain tax-free money you might have received, like earnings from a Coverdell savings account or interest from certain savings bonds or any reimbursements you got that weren't already taxed.
Makes sense. Avoiding the double dip.
Exactly.
Okay, let's switch gears. A really big one. IRA contributions, individual retirement accounts, affects tons of people. Our source mentions three main kinds: deductible, traditional, Roth, and non-deductible, traditional.
Yeah, these are fundamental for retirement planning. For 2023, the general rule is you can contribute the lesser of $6,500 or your earned income if you're under 50.
$6,500 are earned income.
Right. If you're 50 or older, you get that catch-up contribution, so the limit goes up to $7,500.
And for couples?
Married couples, generally $13,000 total, or $15,000 if both are 50 plus. But it's always limited by the couple's total earned income. And the key point is that limit covers all your contributions combined across any type of IRA you have.
That's crucial. You can't put the max in both a traditional and a Roth in the same year?
Correct.
So what counts as earned income for this? Is it just salary?
It's pretty broad, actually. Salary, wages, commissions, bonuses, net earnings from self-employment. Also, non-tuition fellowship or stipend payments if they're treated as taxable income. Interestingly, alimony used to count, but only for divorce agreements from 2018 or earlier.
Ah, okay. And what's definitely not earned income?
Things like interest, dividends, annuity income, pensions, and as I mentioned, alimony from agreements after December 31st, 2018.
Good clarification. And before we break down the different IRA types, you mentioned something else, a credit.
Oh, right. The Retirement Savings Contribution Credit, sometimes called the Savers Credit. It's an extra potential tax break for eligible folks who contribute to an IRA. Worth looking into separately.
Okay. So let's start with the deductible traditional IRA. What's the main appeal?
The big one is the upfront deduction. Your contribution is subtracted from your gross income, which lowers your AGI. So you get a tax break now.
And there's a deadline for that contribution, right?
Mm.
Not just for filing taxes.
Absolutely critical. You have to make the contribution by the tax return due date, usually April 15th. Filing an extension for your taxes doesn't give you more time to contribute to your IRA for the previous year.
April 15th. Got it. How does the money get taxed later on?
Well, the money grows tax deferred inside the account. That's great. But when you take it out in retirement, both your original contributions and all the earnings are taxed as regular income. And watch out for penalties if you withdraw before age 59 and a half, generally. Plus, you usually have to start taking required minimum distributions, or RMDs, after you turn 73.
Okay, now the tricky part, you mentioned limitations. If you have a 401k at
Yeah.
work, for example.
Right. If you or your spouse participate in an employer-sponsored retirement plan, your ability to deduct traditional IRA contributions can be limited based on your adjusted gross income, your AGI.
What are those limits for 2023?
For 2023, if you're single and covered by a plan at work, the deduction starts phasing out at an AGI of $73,000, and it's completely gone once you hit $83,000.
So a $10,000 window.
Yep. For married couples filing jointly, if both are covered by work plans, that phase-out range is $116,000 to $136,000 of AGI.
Okay. But what about that special rule? If only one spouse has a work plan.
Ah, yes. This gets a bit more complex. If you're married filing jointly, and one spouse is covered by a plan but the other isn't, the spouse who isn't covered might still be able to deduct their contribution. Their deduction phases out too, but at a much higher AGI level, between $218,000 and $228,000 of the couple's AGI.
Wow, that's a big difference.
It is, but if you're married filing separately, the limits are very strict. The phase-out is between $0 and $10,000 of AGI for both spouses, regardless of work plan coverage in many cases. It really discourages separate filing for IRA deductions.
So the takeaway is check your specific situation filing status, work plan coverage for both spouses, and combined AGI.
Absolutely. The source has a helpful summary chart, essentially saying if, say, spouse 1 is in a work plan and the couple's AGI is over $136,000, their IRA probably isn't deductible. But if spouse 2 isn't in a plan, their IRA might still be deductible, unless the couple's AGI is way up in that $218,000 to $228,000 range.
Let's make this concrete with that example, Christy.
Yeah.
Single, 40, has a retirement plan at work. Her 2023 AGI is $75,000.
Right. So her $75,000 AGI falls into that single phase-out range of $73,000 to $83,000.
Okay.
Because she's $2,000 into that $10,000 range, that means 20% of her potential deduction is disallowed. $2,000, $10,000 was 20%.
So 20% of the maximum $6,500 contribution.
Exactly. 20% of $6,500 is $1,300. That's the amount she can't deduct. So her allowable deduction is $6,500 minus $1,300, which comes out to $5,200.
Okay, that calculation shows how the phase-out works.
And the follow-up question really highlights the impact. What if Chrissy didn't have a plan at work?
And the AGI limits wouldn't apply to her deduction.
Correct. She could deduct the full $6,500, assuming she contributes that much. It shows just how significant that covered by a plan at work status is.
All right, that covers the deductible traditional IRA. Now let's look at the Roth IRA. Big difference here, right?
Right.
No upfront deduction.
That's the key. You contribute with money you've already paid taxes on. Contributions are not deductible.
So why do it?
The payoff comes later. The money grows tax-free. And if it's a qualified distribution, generally meaning you're over 59 and a half and held the Roth for 5 years, all withdrawals, including the earnings, are completely tax-free.
Tax-free withdrawals in retirement. That's the appeal.
Definitely. But watch out for non-qualified distributions. The earnings portion might be taxed and penalized.
Are there income limits for contributing to a Roth?
Yes, there are similar phase-outs, but these determine if you can contribute at all. For 2023, if you're single, The ability to contribute phases out with a modified AGI between $138,000 and $153,000.
Higher than the traditional deduction limits.
Yes. For married filing jointly, it's $218,000 to $228,000. And again, for married filing separately, it's very low, $0 to $10,000.
Okay, so if your income is too high for a Roth and you're limited on deducting a traditional IRA, what then?
That's where the non-deductible traditional IRA comes in. If your deduction for a traditional IRA is limited because of income or a work plan, you can still make contributions up to the limit that just won't be deductible.
But the overall contribution limit, that $6,500 or $7,500 still applies, right? Combined across all types.
Absolutely. Your total contributions to all IRAs, traditional and non-deductible traditional Roth, can't exceed that annual limit.
And how are these non-deductible contributions taxed when withdrawn?
The earnings still grow tax-deferred. When you take money out, the earnings part is taxed as ordinary income. But the principal, the original non-deductible contributions, comes out tax-free because you never got a deduction for it going in. You have to keep track of those non-deductible amounts, usually using Form 8606.
Right, tracking is key there.
Yeah.
So just to quickly recap the main differences.
Sure. Deductible traditional, upfront deduction, taxable withdrawals, non-deductible traditional, no upfront deduction, contributions withdrawn tax-free, earnings tax, Roth, no upfront deduction, qualified withdrawals completely tax-free.
So it's really about deciding if you want the tax break now or later.
Pretty much, assuming you qualify for the options.
Okay, moving on. Student loan interest, a big help for many. What's the maximum adjustment here?
You can deduct the interest you paid during the year, but the deduction is capped at $2,500.
$2,500 max. And does all the interest paid count towards that cap?
Generally, yes. The interest part of your payments on a qualified student loan counts. But surprise, surprise, there are AGI phase-outs here too.
Of course. What are they for 2023?
For single filers, the deduction starts to phase out at $75,000 AGI and disappears completely at $90,000. For married filing jointly, it's $155,000 to $185,000. And a really important point, married couples must file jointly to take this deduction.
Must file jointly. Got it. Any other catches?
A few. You can't claim it if someone else can claim you as a dependent. Also, you have to be legally obligated to pay the loan.
So if my parents pay my loan, they generally can't deduct it unless they co-sign.
Exactly. And the loan must have been taken out solely to pay for qualified education expenses. You can't just use a home equity loan for tuition and then deduct the interest under this rule.
Okay, specific purpose loan. Makes sense. Next up, health savings accounts, HSAs.
HSAs. Fantastic tool if you have a high deductible health plan. They let you contribute money pre-tax to save and pay for healthcare costs.
Pre-tax contributions sound good. What are the limits for 2023?
For self-only health coverage, the limit was $3,850. For family coverage, it was $7,750. And there's an extra $1,000 catch-up contribution if you're age 55 or older.
But you can't contribute if you're on Medicare, right?
Correct. Once you're enrolled in Medicare Part A or B, no more HSA contributions.
And the money comes out tax-free for medical expenses.
Yes, that's the beauty of it. Contributions are pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. It's often called triple tax advantaged.
Wow. Is there a downside?
Well, if you take money out before age 65 for something other than qualified medical expenses, you'll owe income tax on it, plus a hefty 20% penalty.
Ouch. So stick to medical expenses before 65.
Definitely. After 65, the penalty goes away, but you'd still owe income tax if it's not used for medical costs, similar to a traditional IRA withdrawal.
To have an HSA, you need a specific type of health plan. What qualifies as a high-deductible health plan for 2023?
For 2023, the plan needed a minimum annual deductible of $1,500 for self-only coverage, or $3,000 for family coverage. And there was also a cap on total annual out-of-pocket expenses, things like deductibles and copays, but not premiums. That cap was $7,500 for self-only and $15,000 for family.
Okay. Deductible minimums and out-of-pocket maximums.
Right. The source also briefly mentions Archer MSA's medical savings accounts. They're older, you can't open new ones, kind of a precursor to HSAs, mostly for self-employed folks back in the day.
Got it. Now, moving expenses. This one changed a lot recently, didn't it?
It really did. The deduction is now extremely limited. It's only for active duty members of the armed forces who move because of a military order for a permanent change of station. Their spouses and dependents might also qualify.
So for almost everyone else moving for a new civilian job, no deduction.
Correct. That deduction is gone for most taxpayers.
Okay, let's shift to self-employment. First, the self-employment tax deduction.
Right. If you're self-employed, you pay income tax, and you also pay self-employment tax, which covers Social Security and Medicare, essentially both the employer and employee halves. The good news is you get to deduct one half of what you pay in self-employment tax as an adjustment to income. It helps offset that double burden.
That's a significant deduction.
Yeah.
What about health insurance for the self-employed?
Another good one, self-employed individuals can generally deduct 100% of the premiums they pay for health insurance for themselves, their spouse, and dependents.
100%. That's huge.
It is. The plan needs to be established under the business name or the individual's name if they're a sole proprietor, and the deduction can't exceed your net profit from self-employment. But yes, it's an above-the-line deduction, not itemized.
Fantastic. And continuing with self-employment retirement plans.
Yes, self-employed people can set up their own retirement plans and deduct the contributions, again, as an adjustment to arrive at AGI. These are plans like SEP IRAs, simple IRAs, and solo 401ks.
How do those work tax-wise?
Similar to other retirement plans. For the non-Roth versions, contributions are deductible, earnings grow tax-deferred, and distributions in retirement are taxed as ordinary income. Early and late withdrawal penalties generally apply too. If you use a Roth version, contributions aren't deductible, but qualified distributions are tax-free.
What are the contribution limits for these? Are they generous?
They can be very generous, especially compared to regular IRAs. For 2023, a SEP IRA allows contributions up to the lesser of 20% of your net adjusted self-employment income, or R, $66,000. That limit jumps to $73,500 if you're 50 or older.
20% or $66,000.
Oh, a simple IRA is different, often used if you have employees. The limit is generally the lesser of 100% of net adjusted self-employment income, or after $15,500, $19,000 at 50 plus. Employers often have matching requirements too. And a solo 401k, which is for owner-only businesses, or maybe it just includes a spouse, has contribution rules similar to the SEP IRA, effectively allowing up to that same $66,000 or $73,500 limit, often reached through a combination of employee and employer contributions you make for yourself.
Okay, let's use that example, Peter. Self-employed, $100,000 net income after the self-employment tax deduction. How much could he put in a SEP IRA?
It's based on that 20% calculation. So 20% of his $100,000 adjusted net self-employment income is $20,000.
So he could contribute and deduct $20,000 for his SEP IRA.
Exactly. It's a powerful way for the self-employed to save for retirement and get a significant tax deduction.
All right, nearly there. Penalty on early withdrawal of savings. Seems straightforward.
It is pretty simple. If you cash in a CD early, for instance, and the bank charges you a penalty, that penalty amount is deductible as an adjustment to income. It's basically considered interest you forfeited.
Okay, now alimony paid. You mentioned a critical date here.
Yes, this is crucial. Alimony payments are only deductible as an adjustment if the divorce or separation agreement was finalized on or before December 31st, 2018.
Before the end of 2018.
Correct. For agreements after that date, the deduction for the payer is gone, and the payments are no longer taxable income for the recipient. Big change from the Tax Cuts and Jobs Act.
If the agreement is from 2018 or earlier, what makes the payments qualify as deductible alimony?
Several things. Payments must be legally required by the agreement, made in cash or equivalent, stop upon the recipient's death, not be between members of the same household, and not be labeled as something else, like child support or property settlement.
Right. And how is alimony different from child support or property settlements?
Child support is never deductible by the payer and never taxable to the recipient. If payments cover both, they're treated as child support first. Property settlements are also non-deductible and non-taxable, just a division of assets.
Good distinctions. Last one, attorney fees in certain cases.
Yeah, this is a specific adjustment for attorney fees paid in connection with certain lawsuits, specifically cases involving claims of unlawful discrimination like age, sex, or race, and also certain whistleblower cases.
Is there a limit on that deduction?
Yes, the adjustment amount is limited to the amount of the judgment or settlement that you included in your income from that case. You can't deduct more in fees than the taxable income you received.
Okay, got it. Wow. We've really covered a lot of ground there. From teachers buying supplies to retirement savings, student debt, health costs, self-employment. It's quite a range.
It really is, and understanding these adjustments, these specific deductions, can genuinely make a difference to your bottom line.
Yeah, it's not just about tax time either, is it?
Not at all. Knowing these exist helps you plan better throughout the year. Maybe it influences how you save or what kind of health plan you choose or how you structure things if you're self-employed. It connects directly to your overall financial strategy.
So the thought to leave you with is, how does knowing about these specific adjustments change how you look at your own finances,
Yeah.
your income, your spending, maybe even bigger choices about work or education. Perhaps it's worth taking another look at your own situation, your own documents, with this information in mind. Are you taking advantage of everything you're entitled to? Thanks so much for joining us for this deep dive into tax adjustments. We'll catch you next time.